Somewhere in Sydney right now, a renter is opening an email from their property manager and seeing the words nobody wants to read. Your rent is increasing by $50 a week. Not $50 a month, $50 a week. That's more than $2,600 a year disappearing from a household budget before a single grocery item is bought, before a power bill is paid, before life even starts. And here's the part that matters. Australians were told this kind of impact would be modest. So in this video, I want to walk you through what's actually happening to rents in Australia right now, using data from 3 separate property research groups, and explain what it means depending on whether you're renting, buying, or investing. Because once you look past the headlines, the picture is a lot clearer and a lot more confronting. Let's start with the promise. When the government moved to change investor tax settings, limiting the full benefits of negative gearing and the capital gains tax discount to newly built properties rather than established ones, the broad argument was straightforward. Steer investment toward new supply, increase construction, and improve affordability over time. Treasury's modelling suggested the impact on rents would be relatively small. Nationally, the expected increase was less than $2 a week, spread over roughly a decade. On paper, that sounds manageable, almost trivial. But Australians have heard minimal impact before. When the expanded 5% deposit scheme was rolled out, Treasury modelled a property price effect of around 0.6% over 6 years. In reality, several markets moved 8% to 9% within months. Now, those are different policies in different conditions, so I'm not pretending they're identical. But the lesson is the same. Forecasts matter, yes, but what matters more is what happens in the real market once incentives change and human behaviour kicks in. And now we have that real-world data. 3 separate research houses, Domain, PropTrack, and CoreLogic, using different methodologies, are all pointing in the same direction. Rents are rising quickly, supply is tight, and tenants are carrying the pressure. Start with Domain. In Sydney, median house rents jumped by $50 a week in just 1 quarter, taking the median to $850 a week. Median unit rents rose by $30 a week to $780 a week. That is not a slow drift. That is a sharp move in a very short period of time. And importantly, Domain's own analysis noted that the jump came as investor tax changes became more certain, with landlords appearing to move early to protect cash flow in anticipation of tighter margins and reduced supply. Then there's PropTrack, which shows the same pressure at a national level. Advertised rents are up 6.4% over the past year. In Perth, they're up 10.3%. In Hobart, 9.1%. In Darwin, 7.7%. Across the capital cities, rents are now sitting roughly $40 a week higher than they were a year ago. And then you get to CoreLogic, which really captures the scale of the longer-term trend. National rents rose 1.6% in the June quarter alone and 5.9% over the year, pushing the national median rent to $705 a week. But the more revealing number is this. Over the past 5 years, Australian rents have surged 40.6%, adding about $204 a week to the typical rental bill. In the 5 years before that, rents rose by just $55 a week in total. That's the difference. This is not just a normal cycle. It's not just rents going up a bit. It's a clear acceleration. And when you translate that into household reality, it gets even harder to ignore. 5 years ago, renters were spending around 27% of income on rent. Today, according to CoreLogic, that figure has climbed to roughly 1/3 of household income. In many regional markets, it's worse, with renters spending more than 35% of income just to keep a roof over their heads. And once housing costs move above 30% of income, that's generally considered housing stress. So for a growing number of Australians, this isn't an inconvenience anymore. It's not even just cost of living pressure. It's structural financial strain. Now, the obvious question is, why is it happening this fast? The short answer is supply, and the numbers here are brutal. National rental listings are sitting 16.7% below the 5-year average. Sydney is down 24.1%. Melbourne is down 18.4%. Darwin is down more than 26%. At the same time, the national vacancy rate is around 1.6%, with some cities, like Adelaide, hovering closer to 1%. For context, a balanced rental market usually sits somewhere around 3% to 4% vacancy. Once you get down near 1%, tenants lose almost all negotiating power. Because in that kind of market, if one renter says no to a rent increase, there are 10 more ready to say yes. That's the environment we're dealing with. And once you understand that, the mechanism becomes much easier to follow. Negative gearing has long acted as a kind of buffer in the investment market. It allowed some landlords to tolerate weaker cash flow because part of that shortfall could be offset through the tax system. If that buffer becomes less valuable, especially for established properties, landlords have fewer ways to absorb higher costs or lower returns. So what happens? In a well-supplied market, they may not be able to do much at all. Competition would cap their pricing power. But in a market where listings are scarce, vacancies are near record lows, and demand is intense, landlords are in a much stronger position to pass costs on through higher rents. That doesn't mean every rent increase can be blamed on one policy change. It can't. Interest rates matter, migration matters, construction bottlenecks matter, insurance, maintenance, taxes, and broader inflation all matter too. But if you reduce investor incentives in an already undersupplied market, it should not surprise anyone when pressure shows up quickly on the tenant side. And that, I think, is the key point. This isn't really about scoring a technical win against Treasury by saying, your 10-year national model didn't match Sydney over 1 quarter. That's too simplistic. The real issue is bigger than that. The real issue is that rents are rising fast, supply is critically tight, and policy changes have landed in a market that had very little spare capacity to absorb another shock. So the next question is the one everyone wants answered. Is this temporary? In theory, maybe. The logic behind the reform is that investors will gradually shift toward funding new housing, which should increase supply, improve balance, and eventually ease rental pressure. That theory is not irrational. On paper, it makes sense. The problem is time. Australia is already estimated to be roughly 300,000 homes short of what it needs. The national target to build 1.2 million new homes by 2029 is already under. Construction costs remain elevated. Approval processes are slow. Labour shortages haven't disappeared. New supply does not arrive overnight. Meanwhile, migration remains strong, population growth keeps adding demand, and every month that passes in a tight market gives landlords more pricing power and tenants fewer options. So even if the long-run policy objective is sound, the short to medium-term pain is very real. And that's what people are feeling now. So what does this mean depending on where you sit? If you're renting, the hard truth is that the bargaining power is mostly on the landlord side right now. If rent keeps rising faster than your income, many renters won't be deciding whether to pay more. They'll be deciding what to sacrifice. That could mean moving further out, a longer commute, less space, more instability. It's not a comforting answer, but it's the honest one. If you're a first home buyer, the lesson is different. A mortgage is not a bet on the next 6 months. It's usually a 15 to 30-year decision. Governments will change policy. Interest rates will rise and fall. Sentiment will swing. That's normal. But the bigger long-term force underneath all of that is still the same. Australia has had a persistent tendency to add people faster than it adds homes. And in markets with structural scarcity, waiting for the perfect moment has often cost buyers more than acting decisively on the right property at the right price. And if you're an investor, the message is uncomfortable but simple. As long as Australia continues to run a genuine housing shortage, quality property in supply-constrained locations is likely to remain a resilient long-term asset class, even through periods of policy uncertainty. So here's the real takeaway. This is not just a story about one policy announcement. It's not just a story about one Treasury model. And it's definitely not just a story about Sydney. It's a reminder that when you change incentives in a market already short of homes, the pressure doesn't disappear. It gets transferred. And right now, a lot of that pressure is being transferred directly to renters, in real dollars, every single week. If this helped you understand what's really happening with rents in Australia right now, hit the like button